Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to continue the discussion on NSOs versus ISOs and how to navigate careers and promotions. And so one of the things that comes up with professionals is when there's a promotion or a change of job, potentially the compensation can change. And with that comes some of these different types of investments and strategies. And so while a compensation package, you may look at the salary, the health benefits, but then you look at, okay, what kind of stock options do I have? And suddenly you're forced to hear about ISOs, NSOs, AMT, and then you're thinking, what is all this? So we're going to take a step back and really educate you on what that is and how it works. I know we've had a couple conversations, but we definitely feel this is very important and want to make sure that you understand exactly what it is that we're sharing. So let's go ahead and get started.
Let's jump in. So let's start with the foundation, because on the surface, these stock options can look very similar and do look similar. And so when you are granted your compensation package and you say, okay, what is this equity compensation and how is it taxed? What does it mean? Let's just jump in and talk about incentive stock options and what the difference is between that and a non-qualified stock option. So with ISOs, typically, what you're told is there's not going to be any tax when you exercise. And that can be a big surprise later if you don't know all of the rules that go around them. So let's just talk about incentive stock options and how they're different from non-qualified. So they are more restrictive, meaning, let's say you're an employee, you will only be granted the incentive stock options. Where, let's say then you become a contractor, then you also can then receive the non-qualified stock options. And that's one of the differences, is that they are, because of the tax differences, the ISOs are more restrictive. There's another thing about them, is that you can only exercise up to $100,000 of those options on an annual basis.
Oh, interesting. Okay.
Yeah, and you cannot do that with NSOs.
Okay.
The tricky thing about the incentive stock options that usually takes people by surprise is something called the alternative minimum tax.
I said, there we go. That's
so
the popular,
AMT.
yes,
Yeah,
for a long time.
For a long time, and a lot of people were getting hit with AMT. And let's just take a step back, because AMT was actually enacted back in 1969.
Oh, it's been around for a while.
It's been around for a while.
Okay.
And originally, there was a public outrage about the tax system, and where there was like 155 very, very wealthy taxpayers that were using all the tax loopholes and credits and everything, and they were paying zero tax. So, but unfortunately, the AMT was not indexed for inflation until 2012. And so what was happening is that a lot of people were getting caught up in the alternative minimum tax.
And they're thinking, I have all these loopholes, I'm not paying tax, and then they get blindsided.
They get blindsided with this. Wow. They're like, why do I end up, why do I owe tax? So let's just come back to the differences between the two. So, and how the taxation works, because they differ in their eligibility and their taxation. So eligibility meaning, if you're an employee, it's probably going to be an incentive stock option or a non-qualified stock option. If you are a contractor or a director or a consultant for the company, then you're only going to be getting the NSOs.
Got it.
You're not eligible for the other. So with both of them, what you're taxed on is the difference between what you can exercise for and what the fair market value is. So let's just to illustrate this point, let's talk about an example.
Okay.
So let's pretend you're working for an early stage company, and they grant you options at an exercise price of 10 cents per share. But the company, the fair market value of the stock, is trading is valued at $1. So the difference between that is 90 cents. So I've actually had a client that this happened to, and I'm not going to name it because we're not allowed to name stocks, but it's a well-known company, and she was brought on board, and they said, okay, you've got this equity compensation, it's an incentive stock options, and they granted her, and she then some shares, and she ended up, when she exercised, it was $60,000 that was added to her income.
Wow.
And they said, oh, you're not going to have to pay any tax on this. But unfortunately, what happened was, because they said, oh, it's an incentive stock option, you're not going to pay any tax, they didn't tell her about the AMT, or the alternative minimum tax.
Okay.
So for AMT, what happens is you file a separate, basically, it's two tax returns in one, but it's a parallel tax system. And so you calculate the regular tax, and then you calculate the alternative minimum tax. And so that income, or whatever that difference between what you exercise at and what the fair market value is, they call it the strike price or the bargain element, that gets added to your income for alternative minimum tax purposes, but not for regular tax purposes. So when you run your taxes under the regular tax system, you don't owe. But when you run it under the AMT,
interesting.
then you do owe. And so that's where really
that's why it's important to do the tax planning and have these conversations beforehand.
Well, and think about it this way: it's phantom income. You don't have it. You just exercised. It's still sitting there in the brokerage account. Yeah. And so unless you sell something to cover the taxes, you don't actually have that money in your bank.
Yeah.
So that's where it gets tricky. And the other piece of when it comes to incentive stock options is you're going to be paying tax on it potentially when you exercise. You have to hold it from a year afterwards to qualify for the capital gain treatment, or 2 years from the date of grant to qualify. Otherwise, it is considered a disqualifying disposition. So if you look at the NSOs, that's taxed when you exercise. And so you do need to be looking ahead for that, because there's going to be a tax hit. And so it's the same as with incentive stock options. You pay tax on, so you're granted, let's say at 10 cents, the fair market value is $1, you're paying tax on 90 cents per share. And so that gets added to your W-2, it's taxed as ordinary income. And then if you hold that stock for a year and a day, then you end up paying long-term capital gains rates. So there are differences between the two, but there are a lot of similarities where you are paying tax on that bargain element, or the difference.
And it sounds like there's a lot of tax planning too involved.
Yes, absolutely. You definitely want to plan ahead for that, because otherwise you can end up in a very high tax bracket and not have money to cover the taxes. Yeah.
So let's talk a little bit about kind of some changes to consider, think about after a promotion. So obviously you've changed jobs, or you have a new job, and you have potential salary increases, bonus increases, equity grants, and all of a sudden tax planning does become extremely important, like we just talked about. And one of the things we also see is potentially if a professional that used to get the ISOs are now in a leadership role, and they're getting now the non-qualified stock options. So once again, that changes the taxes, and so that's where it's important to look to make sure that what's the tax strategy going forward. And then it's also a question of looking at, or sometimes I think as you get these stock options, you think, okay, I own this stock, it's gone up, I'm wealthy, everything's wonderful. But the reality is, well, once again, you have to cover the tax part of it. And then once again, how are you positioned with your money and your allocation, which we'll go through a little bit later. But I think the idea sometimes is, I have this stock, it went up and everything's wonderful, but the reality is there's a lot more planning.
You might not have the liquid cash to cover the taxes.
And that's a big part too, is making sure you have the money for that.
And one of the things that I see with clients is often they're granted these options. And so then it becomes a question of, when do I exercise? Yeah. And so they're looking at, maybe the stock price is going up, going up, but you need to be keeping in mind the spread.
Yeah.
Because, so let's say you're granted shares and it's got a strike price of $20. And the current market value on the stock is trading at 80. The spread there is 60. So it depends on how many shares you're exercising, because the amount of income that's going to get added to your W-2 can grow dramatically, especially if you wait and the stock price is going up. So if your strike price is 20 and the fair market value is 80, then that's a $60 times, let's just say 100 shares, that's $6,000. But if you exercise 1,000 shares, that's $60,000, and you want to make sure that you've got the liquid cash to make sure you're covering it. And if you wait longer, let's just say that the fair market value goes all the way up to, 150, then you've got $130, and that's all taxed as ordinary income, versus maybe exercising when the strike price is lower. You're paying ordinary income on the smaller spread, and then you can hold the stock, and you pay long-term capital gains if you hold it for over a year.
Yeah. So there's some strategy and technique.
There's a lot of strategy there, because people always think, I should wait.
Yeah.
And it might not be the best idea.
And so timing is definitely important. Looking at this, it is an investment decision, but also a tax decision. And so some of the things you have to coordinate are, can you exercise over multiple years? Do you have any lower income periods that are coming up or anything that's going to change with your household income? Are there any expected bonuses? Because sometimes bonuses, they fluctuate a little bit too. Yeah. So that's kind of a tricky part. And then, looking at if there are any other liquidity needs that you need, and if you have money set aside, and is it for this or for something else? And so what we want to avoid is having everything happen all at once. Right. I mean, whether it be bonuses or restricted stock options, capital gains.
All in 1 year.
Yes. It's like, oh, wait a minute. But there are different cases. We've worked with clients in the past where, if they're we had a client that was phasing into retirement. They had some stock options, and they were at a place where they wanted to exercise and their options and pay the taxes and be done with the stock because they had such a big concentrated position. They didn't want to risk that volatility potentially of that position because years prior, they had had some stock options that were worthless later. So once again, it's not that happens to everybody, but you have to look at, what's the purpose of the money? How much taxes are you paying? But then the client that actually ended up exercising paying all the taxes, they are set for the rest of their lives. They have enough. It's all going to work out. And so it's just, once again, it's looking at overall, what's the overall situation and how does this apply?
And real life, actually, you really need to look at different scenarios in terms of, okay, are you married? Are you single? What is, like you said, what is the year going to look like for income? Mm-hmm. Maybe you're married and your spouse may be between jobs. And so that might be a great year to look at, okay, well, right now we're in the 24% tax bracket as a married couple. 24% bracket goes from about 211 to 403. So let's say both of you had about $200,000 salaries, and now all of a sudden you're down to the $200,000. You've got $200,000 of a tax bracket 24 before you jump to 32 that you could look and say, okay, is this a really good year to exercise some of those stock options to fill up my 24% bracket? Mm-hmm. And because otherwise in future years you might be in the 32, 35, or 37% bracket. So I think there's definitely looking at where are we with our jobs, and maybe you're in between, or maybe one of the spouses is taking time to raise the children at home and not working outside the home. So I think that there's definitely some planning opportunities around that. Something that I didn't mention that I think is really important to keep in mind with incentive stock options is with that AMT, or the alternative minimum tax. And so when you're granted, there's no taxable event. When you exercise, there's no taxable for regular, but there's the AMT. But then in future years, there's something called an AMT credit. And so what that is, and it carries forward indefinitely. And so basically when then your regular tax is higher than your alternative minimum tax, there's a credit that's available that you may actually be able to use to offset. Okay. So, and it often happens with incentive stock options. So never fear, there is some help.
Okay, good. That's always good to know.
With that. But I wanted to mention that because we didn't talk about that earlier.
Nice. So one of the things we kind of alluded to, but another issue is the concentrated stock. And so here you are, potentially you're working with the company, your salary depends on the company, your bonus depends on the company, your stock options depend on the company. Sometimes, not all, but it's case by case. Sometimes there's 401k plans that do match with the company stock. And so once again, all of a sudden, a lot of your wealth could be tied to one company. And so there is a lot of potential risk with that. Now, it could grow and, gain, and which is great, but it also can go the other way and you could lose, which is the example I shared earlier. And so it is important to, once again, look at overall what are some strategies to diversify and making sure that you're efficient in your investment plan, and how does this all tie together? And that's what we're here for. We really work with our clients to make sure that they are diversified. And yes, stock options are great, but how do we make it sure that you have other...
But it could really create a lot of financial stress when both your income and your investments are tied together and the market goes down.
Yes, it can be very stressful.
Yeah. So let's just kind of circle back and talk about the common mistakes that we've talked about. So number one would be maybe waiting too long to exercise, and the price is going up, up, up. And that spread is getting bigger, bigger, bigger. So you're going to be paying way too much of ordinary income and not enough capital gain. Thinking about the AMT, or alternative minimum tax exposure. because you've been told, oh, yeah, you're not going to pay any tax when you exercise. You definitely need to look at your entire tax picture to make sure that doesn't apply to you. One of the big ones I see is assuming that withholding is sufficient.
I see that's a big one because I feel like I hear that all the time. Oh no, they withheld money for me, and then you're like, are you sure that was enough?
Yeah, exactly. So you want to make sure you're doing planning ahead of time.
Yes.
You need to make sure you're planning for liquidity because taxes that is a thing. And as you just mentioned, the overconcentration in one position, one company. And oftentimes we see people making decisions emotionally and not strategically, so that can be a big mistake. So avoid surprises, reach out for help, and we really, really love to help.
So a better way to think about stock options is really kind of looking at the overall strategy and not just the stock option, but really looking at the taxes, your cash flow, the investment risk, retirement planning, diversification, and kind of long-term wealth preservation. And so once again, it's this could be very lucrative for you, but having a strategic kind of financial plan and plan in place for the investments that are tied overall is important. And once again, the tax part is really key. So it is, a combination of taxes and the investments. They do go hand in hand, especially for these particular situations. And I know we covered a lot, and we've been covering this the last couple sessions.
It's coming up a lot for clients.
It is.
And people have questions about it, and it's really confusing. What do I own, and how does it work, and what's the taxation?
And I think the tax part, really trips up some people. They don't realize there's ways to plan around that a little bit. So we're here if you want us to evaluate your situation, or if you just want to chat. We're open for a strategy session, and you can reach us at 760-692-5700. That's 760-692-5700. And we want to thank you today for getting savvy with us about your finances. And remember to savvy up. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.